index universal life insurance works like this. If I were to put $1 into it, and there are many ways to design this, right? So I'm going to tell you what I usually see. If I put $1 into it, I'm going to have in my net surrender value, is what this is called. If I were to cancel and pull the money out today, my net surrender value is usually going to be oftentimes 0 the first year. Okay. Versus on a whole life insurance policy, a sacred account, my net surrender value is usually going to be 70 to 90 cents in the first year. Right? Why would this be important? I can't take a loan against 0, right? Like I can't borrow against the number 0. There's nothing there to take a loan against. On this side with the whole life, right? This is net 70 to 90%. I can take a loan against that. I can pay off debt. I can invest. I can do all sorts of things with it. Now this dollar is growing at about 3 to 5%. Either way, that's the kicker. Index universal life insurance does not grow that much more than whole life insurance. When you look at the actual net surrender values on in-force illustrations, maybe you're going to get 6, maybe you're going to get 7%, but generally it's about the same as a whole life policy. So you've got about the same return. Okay. You've got a lot less money to use up front. And I can't borrow against those smaller numbers. So the index universal life, we'll just call this IUL, is a later plan, right? Meaning I can't use this now. It's not designed for me to borrow against today in most cases. The whole life, we'll call this a sacred account. This is a now strategy. I'm going to use it now. Okay, now here's why this is 0. The first year, all of the money that you put into it goes to commissions and fees. Like the agent that sold this makes, if they sell, you know, a $10,000 annual premium, they're going to make most of that in commissions and fees, right? Like they're going to get a lot of this, especially here's the difference here. The term and the IUL, the insurance, because this is life insurance, the insurance is called annually renewable term. When I sell annually renewable term, oftentimes the commission on this will be 100 to 130% of the first year premium. This isn't even IUL. Like this is just annually renewable term. Now, IUL uses annually renewable term, meaning the life insurance component is term insurance. The cost increases every single year, right? But if I, as a life insurance agent, just sold someone annually renewable term, the company that I sell with is generally speaking going to pay me 100 to 130% commission on the first year premium, meaning they might even pay me more money than they make. Why? Because they know next year the premium is going to go up and the year after the premium is going to go up and they're going to recover their costs. So this is how annually renewable term works, is every single year, your cost goes up. Your premium goes up. On an index universal life insurance policy, you've got some money that covers the term insurance. You've got some money that goes into cash value. But when the premiums come up, which they do and will every single year, the money comes out of cash value. Right? I'm gonna either have a less money going to cash value out of my monthly contribution, or my monthly contribution will be the same, and I'm gonna have less money in my cash value because it pulls out and starts liquidating itself. Right? Neither of these are great. These are not great options. Right? So this is one of the things that I don't personally like about about index universal life insurance. Is that I can't use it today. It does have a term insurance base. That's the type of coverage it is, versus with the sacred account, it's whole life insurance. Right? Whole life is a fixed cost. It's something that's never going to go up in price. I'm going to have that locked in for the rest of my life. Think of it like a mortgage. Like if I do a mortgage, my mortgage is going to be the same payment for the next 30 years. It's not going to go up. Right? If I have a fixed rate conventional mortgage versus renting. If I rent every single year, my rent's going to go up. And that cost has to come from somewhere, right? And so I'm either going to have to earn more income or it's going to come out of my savings. No different than a universal life policy. I'm renting the insurance coverage. Every single year, the rent goes up, the coverage goes up. I either need to pay that through contributions or it's going to come out of my cash value, which is my savings. That doesn't happen with whole life, right? Now, the other problem that I have with universal life is that they say it's guaranteed against loss. Okay, so generally speaking, like the cash value, and this is where they're going to tout it, is they're going to say, hey, this is going to be invested on a stock market index, meaning it's going to copy the stock market to a degree without actually being in the stock market. So you can't lose, right? So if the market goes up, you might get a percentage of that upside. Okay, so percentage of upside. Okay, if the market goes down, you get 0%, meaning you never lose money. They call this a floor. Okay, now here's the issue. A lot of times they'll say the floor is 0%. Agents will think, oh, 0% means no loss, right? 0% doesn't mean no loss. 0% just means your account was credited with 0. Okay, it does not mean you didn't lose money. What I'm saying here is there's still fees. If I have a 0% year and I have, insurances have things called riders, right? You can add riders on an insurance policy. Riders are like bells, they're features. I can add, these little different things on there, but there's always going to be a fee. So having an index has a rider. That rider has an annual cost. Having a non-lapse guarantee has a cost. Like all these different things have a cost. So I might have been credited with 0, but I still might have fees of 2% that year. Where are those fees going to come from? My cash value. 0 minus 2% in fees means my cash value went down by 2%. I still lost money. That's not 0, that's -2. Right? So I might lose less, but I'm not losing nothing. It might not be as bad as being in the stock market, but in a down year, I'm still not guaranteed against loss. With whole life, it is guaranteed against loss. You cannot lose money. There aren't these fees coming out in a negative year. Right? So when I look at savings, like an IUL is not a savings account. Right? So whole life, this equals alternative savings account. I can be my own bank. I'm going to borrow against this thing. I'm going to use it for all the things I would want to do in my life, including saving money. The IUL is not like that, right? It's a later plan. This is more like an alternative to a Roth IRA. Okay, and when I think about this, a Roth IRA, it's something I'm going to use down the road when I'm 60. It's the thing I talked about at the very beginning of this course. 60 years old, I put enough money into it, it grew. Now I'm going to start taking money out. Right off the bat, that's not the plan for me. Okay, I want to be able to be my own bank. I need to be able to take a loan tomorrow, not in 10 years.
If you're wondering, what does Wealth Dynamics do? How can we actually help you? Number one, if you haven't gotten a copy of my book, Blueprint to Financial Freedom, grab one now. You can get that down in the comments in the video. You can get the link for that. And finally, if you have a desire to start getting help walking through these different phases toward financial freedom, book a call with my team. Go to our website, set up a call. We're able to help out and answer questions. That's how we can help you. Thank you for watching. Like, share, subscribe. Make sure you turn notifications on, and I will talk to you guys on the next video.